Good morning, everyone, and welcome back to our weekly webinar series. At episode number 162 today, we are starting with a detailed three-part series on ARCs. ARCs have been crucial to our ecosystem in India for stressed asset resolution. Over to Anil sir to take it forward.
Thank you, Ankit. We are starting a kind of complete education series on asset reconstruction companies. This series, which will have three parts, will be exclusively on the law related to asset reconstruction companies under SARFAESI law, then the procedures, latest developments, and various judicial pronouncements about asset reconstruction companies, not about the recovery of debt, but asset reconstruction companies as far as their registration is concerned, their compliances, what are they entitled to, securitization, and latest RBI guidelines on the total operations of asset reconstruction companies. This entire series would be very, very useful for all ARC, anyone who is interested in any ARC, any bank or financial institutions who are dealing with the ARCs or they are trying to assign any debt to ARCs. It would be very important for all chartered accountants, all insolvency professionals, lawyers, and students. Particularly, any person who is interested in or dealing with asset reconstruction companies or likely to deal with or likely to assign any assets to ARC, this three parts of this series would be very, very important. And then in case there is no immediate subject comes on, we will do this in continuation as episode number 162, episode number 163, and 164. Unless there is some urgent announcements made by IBBI or any urgent judgment which is pronounced and becomes important. Otherwise, these three episode number 162, 163, and 164 would be completely on this series on asset reconstruction company. We as AAA weekly webinar series, we thought that the stressed assets, as our audience deals with the asset reconstruction companies, and in fact, the increasing role of ARCs with the formation of bad bank, or what we call is that NARCL, has become very important. Most of the larger defaults are now getting assigned to NARCL. Also, as AAA weekly webinar series, we are thinking of coming a kind of education series on NBFCs regarding the how the NBFC can be formed, what are the RBI guidelines, what are the stipulations and the requirements for NBFCs, and also about various kinds of NBFCs in India, and what are the objectives of each NBFC. So after this series of asset reconstruction companies, we will start another series on NBFCs. So thank you very much, audience, and all my participants in joining this AAA weekly webinar series. So we can start our subject topic today, which is asset reconstruction companies, a learning series in three parts. We would be covering in part 1, legal framework and evolution of ARCs. Then in part 2, we will cover RBI directions, governance, and also what are the stipulations and operational guidelines under SARFAESI Act. Part 3 would be assignments, investment structures, and also IBC interface. So these are the three parts, and in case, because of the time constraint, in case any part is actually continued in the next part. So accordingly, the parts can be increased, but we will not leave any subject untouched. So that is what is our study. Our legal team is working on it. I thank a lot to my legal team, and that legal team presently it comprises of advocate Ashwarya and advocate Ritika. And then I thank them for giving me all the inputs and also spending time on all the entire research. See, let us start with the evolution, like why ARCs were needed in India. It was early 2000 when the Indian banks were struggling with a huge problem of bad loans or NPAs. These are loans that borrowed stopped paying and borrowers defaulted. The existing system at that time for recovery was very slow and it was ineffective, and the banks were supposed to go to various uh, the banks were supposed to go to various courts for recovery of their debt. At that particular time, the idea of asset reconstruction company in fact came into picture, and it was kind of because of the growing NPAs in banks in 1990 and in early 2000, many businesses failed and also stopped repaying loans. Also, in some cases, the business was not failed, but understanding the recovery process in the country, it was also pretended to be failed. And it was also cases of siphoning of the bank loans to other entities and for other purposes, and then finally saying that this loan has gone bad. So the bank actually will start recovery process, which will take years. And by that time, the promoters will fulfill their objectives of siphoning off the substantial part of it. That was, in fact, plaguing the Indian uh, loan market or Indian banking at that time. So therefore, the banks, in fact, were stuck up with thousands of crores of NPAs, and that affected the capability of the banks to offer fresh loans. And when the fresh loans are not offered, it adversely impacted the economy. It adversely impacted the business environment and also the industrialization. The legal system, that is the civil courts and BIFR, and also the debt recovery tribunal under the recovery of loans. That was the law at that time. So the DRT application, it was time consuming. BIFR, we have seen there was no result. And the civil courts, it was delayed. So therefore, the borrowers enjoyed that time, and the loans were in fact shown as bad. The businesses were shown as bad, but it was not really bad. It was the undue advantage of having no solid and robust system of recovery was not there. It was basically using that. So banks were losing time and energy in chasing bad loans, and the tools that they had at that time were not really enough. Then we, in fact, started learning from international models, and Indian government, in fact, saw various models across globe, and it was seen that in USA, in USA, the US government, in fact, created a Resolution Trust Corporation, RTC, and all these bad loans were transferred to Resolution Trust Corporation, and it was cleaned up. The entire bad loans were cleaned up for up to a particular period. Then the Indian government also saw, in fact, the committee that was formed by the government, that committee, in fact, also saw that there was a similar effort made by government of Malaysia, where there was actually called Danaharta in their own language, Danaharta, and there was a company which was made in 1998 by the government. It was in their own language. It was Pengus Susan Danaharta National Berhad. That was the kind of name in their own language. but it was in June 1998 that Government of Malaysia, in fact, Ministry of Finance, the purpose of that particular organization was to acquire, manage, and resolve NPAs from Malaysian financial institutions, and the legal framework which was promulgated at that particular time by Malaysia government was Danaharta Act 1998. Danaharta Act 1998, which provides special powers, and in this particular case, the most of the NPAs were cleaned up, resolved, and that is something which we actually could see. And another example, we also saw in South Korea, a corporation was formed, and the name was, in short, it was called 𝐂𝐽, but it was Korea Asset Management Corporation. Korea Asset Management Corporation, which took over toxic assets and bad loans from stressed Korean banks, and the decision to all these kind of global models that the committee had seen, and then in that particular reasons only in India, some at that particular time, the asset reconstruction company concept came. It was brought in along when the SARFAESI Act was promulgated in 2002. And of course, of late, exactly like this, the Indian government has in fact formed a bad bank, and with the correct legal name of that company is National Asset Reconstruction Company Limited. In short, we call NARSL. Also, along with this company which is acquiring loans, there is another company which the government has floated, all the banks collectively have proposed and sponsored, that is India Debt Resolution Company Limited, which is in short is called IDRCL. IDRCL and NARSL was floated, and it is actually taking over most of the cases. So therefore, the ARCs are becoming important. The NARSL is getting funds, and NARSL is in fact acting in various acquisitions, and India Debt Resolution Company Limited in fact is acting in resolution. They are in fact resolving all these debts. So this is where the Indian government also took some clues, and therefore the Tiwari Committee 2, in fact, the Tiwari Committee 1 was set up in 1981, and this committee at that time, also formerly known as Committee on Functioning of Public Sector Banks, was chaired by Shri M.N. Tiwari. It was seminal report that laid foundational thinking around asset quality management and recovery mechanism in India. While this ARC did not exist at that time, the Tiwari Committee did suggest the idea of specialized institutional mechanism for handling bad loans, which eventually evolved into the asset reconstruction companies framework. After learning from all these other countries, the private ARC structure was recommended, because the government of India at that time expected that in this private or public sector, ARCs would invite investment from outside, from private parties in these stressed assets. Then the expert committee, in fact, raised alarm in 1998. The another committee, which was Narasimhan Committee. Narasimhan Committee, it was in 1998, suggested setting up specialized institutions to handle bad loans. These institutions would take over NPAs from banks and try to recover them in a focused and professional way. The idea was to let banks focus on lending and let another expert company handle recovery. This was the concept of asset reconstruction company, which was in fact given in the report of Narasimhan 2 committee report. So this Narasimhan 2 committee report, it was in fact addressing the issue of the rising NPA in public sector, banks recommended creation of asset reconstruction companies to take over doubtful and lost assets from banks. It proposed that these assets be transferred into an ARC, which could be established by banks or private parties. So the original mandate from the committee was that the ARCs can be established by banks or private entities. So in case we see the history, almost each bank, each public sector bank has actually floated collectively or individually an ARC. And then there are private ARCs like Edelweiss or even 𝐂𝐽𝐬𝐬𝐿 or even JM Financial. So these are our private ARCs, and even Pegasus. And there are public sector banks sponsored ARCs like ARCEL, like 𝐂𝐽𝐬𝐬𝐿. So there are and there is one. So there are 4 or 5 floated by public sector banks or sponsored by public sector banks, and there are many, in fact, which actually was formed by private persons. There are about 28 asset reconstruction companies in India registered by Reserve Bank of India, and those are functioning. Along with this, the committee suggested that while the bad loans, while the NPAs will be assigned to these ARCs, the relevant stamp duty exemption would also be given. So the stamp duty exemption was also given as per the recommendations of Narasimhan Committee 2. Now coming to finally the SARFAESI law, which in fact was promulgated in 2002, SARFAESI Act was passed, and then it was basically the objective of this was a faster loan recovery. This law, in fact, let the banks recover their loan without going to court. The specialized company, it allows new companies, ARCs, to buy and recover bad loan. This was a big change, making recovery faster and better. See, now we look at what was the SARFAESI Act 2002. The Act had, in fact, 4 major parts. The SARFAESI Act, in fact, had 4 major parts. One part was securitization of financial assets. One part was securitization of financial assets, which actually the purpose of this part was to enable banks and financial institutions to convert NPAs into tradable securities. To convert NPAs into tradable securities, because this was only given to ARCs, that it can be only given to ARCs. However, the RBI has given draft guidelines last month, and according to those draft guidelines, now in case those guidelines will be notified, it would be possible that the NPAs can be converted into tradable securities and can also be assigned to or can also be sold to private parties other than ARCs, and even the AIFs and even the HNIs. So this is what is the new proposal from RBI, which is yet to be notified. But as per the SARFAESI Act, NPAs can only be assigned to asset reconstruction companies. So how it worked, the financial institutions, banks, transfer their stressed assets, their NPAs, to asset reconstruction companies. Then the ARCs will issue security receipts to investors backed by these assets. So the investors will invest in ARC. ARC will take the assignment of the debt. ARC will recover, and out of the recovery, the amount will go to either the investor, or in case there is no asset, then it will go to the originator. Originator in this case is the person who has given originally the loan. So the security receipts can also be issued to the originator. That means the security receipts can also be issued to bank or financial institutions who is assigning the NPA to ARC. No, the Section 5 acquisition of the financial assets by ARC, and the Section 7 deals with issue of security receipts, and Section 9 deals with measures of asset reconstruction. Now, Part 2 of SARFAESI Act. Part 2 of SARFAESI Act deals with asset reconstruction companies, its formation, its registration, and its monitoring and regulating. This Part 2 deals with the ARC, complete management and monitoring of ARCs. Section 3, in fact, provides for the registration of ARCs with RBI, and the ARCs may undertake restructuring, change of management, settlement, sale of secured assets. All these powers were given to ARCs. All these powers were given to ARCs. And then the regulations, the RBI issued regulations, guidelines, and directions for ARCs, and also prescribed the net owned funds which are required for registration of an ARC. So, as I said, there are various examples, Arcel, Edelweiss. So, all these examples are there. Now, the Part 3 of the SARFAESI law was enforcement of security interest, where in fact the AAA group started its operations in 2003 in the name of AAA Capital Services Private Limited, and we started providing services to all the banks and institutions under this Part 3 of the SARFAESI law. This particular part, in fact, it enabled the banks and the financial institutions to recover their dues without any court intervention. So that complete process was in fact outsourced to various companies like AAA Capital. In fact, we were the first one in India to be empaneled by State Bank of India in a group of about 30-40 people. So in fact, that was the first time the AAA started its journey with the stressed assets. Before that, AAA was working for BIFR. It was also working for various other rehabilitation proposals, nursing proposals. So Section 13, Section 14, 13, 13, Subsection 4, it was all basically was dealing with the enforcement of security interest by the banks and financial institutions, and therefore the appeal, the adjudicating authority was in fact the DRT and DRAT. So that we have already discussed many times. So the Part 4 was also very important. Part 4 of SARFAESI Act was in fact dealing with the concept of central registry of mortgages. Central registry of mortgages, and then the Government of India in fact incorporated this agency, Central Registry Agency, and that was Central Registry of Securitization Asset Reconstruction. So that was the SARFAESI. SARFAESI was formed, Central Registry of Securitization, Asset Reconstruction and Security Interest of India. That's in short, we call it SARFAESI, CERSAI, that is SARFAESI. And Section 20 of the SARFAESI Act, in fact, deals with Central Registry. Central Registry, the purpose was to prevent multiple lending against the same property, to provide a public access to the records of security interest. And also the public interest was supposed to be created, the functionality. All the banks, FIs, ARCs, in fact, are mandated, and it is must for them to register all their mortgages, hypothecations, assignment of receivables, security interest created on movables or immovable assets to Central Registry. It is mentioned in 26 capital E of SARFAESI Act that in case it is registered with SARFAESI, then the priority of entitlement is completely decided in favor of the registrant. In case it is not registered, then he cannot claim priority. So in that case, the registration has a huge legal impact. Registration with SARFAESI has a huge legal impact, as this registration will decide about priority of charges and also the transparency to third parties, and it is mandatory. It is mandatory for enforcement of security interest of the lenders. So these four pillars of SARFAESI Act for the purpose of recovery of dues to banks and financial institutions and ARCs and NBFCs are very, very important. Actually, this gives an opportunity of investment which can come from outside or which can come from insiders, and the assets can be securitized into ARCs. Then it also kind of monitor and regulate ARCs, and it gives the banks a complete power to enforce their security interest without any delay, without any court intervention, and also it enables sale of the NPA assets in bouquet to outside companies or to ARCs. So, Ankit, we have already completed 30 minutes. And in case you feel that, yes, there is anything that you would like to add, so that can be added. Because see, this is something which is a kind of education series, and we are not even expecting much of the questions till we complete this. What do you say about it?
No, I think yes, that's true. That in this what we're talking about is something that many people can have basic questions on. But I can see some questions, but I think those are like questions that we will deal with as we kind of go deeper into the subject. And of course, I believe nothing that I can add from my end. But of course, if somebody amongst our participants would like to add something at this point in time based on what we're already talking about as per SARFAESI Act, or they would want to kind of ask queries which are directly linked with what we're talking about right now, they're most welcome.
Okay, so because see, this is a subject which is a kind of education series, Ankit, so we can start with the key definitions under SARFAESI Act, which is relevant to ARCs only. Although there are many definitions, but we are restricting ourselves to only those definitions which are specific to ARCs. So first of all, let us understand what is the definition of asset reconstruction company, which is provided in SARFAESI law under section 2, subsection subclause BA. It says that the asset reconstruction company means a company registered with Reserve Bank under section 3 for the purposes of carrying on the business of asset reconstruction or securitization or both. Once we see that the definition of ARC is also having a word called asset reconstruction, so therefore immediately it is our duty to go to the definition of asset reconstruction, which is again provided in section 2 of the SARFAESI law. Now, this definition says that the asset reconstruction means acquisition by any asset reconstruction company of any right or interest of a bank or financial institutions in any financial assistance for the purpose of realization of such financial assistance. One, that the asset reconstruction means acquisition by an ARC. First of all, it is only applicable in case the acquisition is done by ARC. Number two, it is applicable to any right or interest of any bank or financial institution. We'll come to the definition of the banks or financial institution, because of late, the financial institutions for this particular purpose was actually having the NBFCs also, housing finance companies also. So therefore, the banks and financial institution means all the lenders, primarily the specified NBFCs and financial institutions and the banks. And in fact, when we say acquisition of any financial assistance for the purpose of realization of such financial assistance can be of any kind. We will also come to financial assistance. So before we go to the financial assistance, we also can say financial asset. So this is the definition of financial asset is also very important, which includes loans, bonds, debentures, hire purchase receivables, or any right to receive payment of money due from a borrower, whether secured or unsecured. So when we see this, we also can see in detail the definition of financial asset means debt or receivables, and includes one, a claim to any debt or receivables or part thereof, whether secured or unsecured. Any debt or receivables secured by mortgage of or charge on immovable property, or a mortgage charge, hypothecation, or pledge of movable property, any right or interest in the security, whether full or part, underlying such debt or receivables, any beneficial interest. So this is what is the definition, or any financial. So any kind of financial assistance, actually, this becomes the debt. This becomes the debt. Then coming to the financial institution. So the financial institutions are defined as a public financial institutions within the meaning of Section 4A of the Companies Act. Then any institutions specified by the central government under the recovery of debt due to banks and financial institutions. Then the International Finance Corporation established under International Finance Corporation Act, and then debenture trustee registered with the board and appointed for debt securitization. Then ARC, whether acting as such or managing a trust created for the purpose of securitization, any other institution or non-banking financial company as defined, that will be, of course, the central government will declare from time to time. Then there is a definition of obliger. The obliger is a person liable to the bank or financial institutions under a financial asset, whether as a borrower, as a guarantor, or otherwise. Any person who's a borrower or a guarantor or otherwise, in case he is liable to pay to the bank, a financial institution, a financial asset. Now, the financial asset we have seen, and any person who actually is obliged to pay that financial asset to the banks and financial institutions is called collectively as obliger, which may include a borrower or a guarantor. The NPA again has been defined. NPA again has been defined as the non-performing assets, as the substandard assets or doubtful assets or loss assets as per the prudential norms issued by RBI from time to time. Then when we see the definition of originator, the definition of originator is also very important. Now, the originator is actually a kind of a means the owner of a financial asset, which is acquired by an asset reconstruction company for the purpose of securitization or asset reconstruction. Now, the originator is the original owner of the financial asset. And we have seen what is a financial asset. Any kind of financial assistance given to any person is a financial asset. Then who can be the originator? Who can be the originator? I believe all the scheduled commercial banks and the financial institutions and even the NBFCs approved. All these are the originators. So these originators are in fact important. Then coming to the legal foundation of ARCs. The legal foundation of ARC is like, first of all, the first foundation is the registration of ARCs with RBI. No company can act as an ARC without RBI registration. And it ensures only qualified entities handle stressed assets. So the registration of asset, which is actually defined under the SARFAESI law, it says that no asset reconstruction company shall commence or carry on business of securitization or asset reconstruction without obtaining a certificate of registration granted under this section by RBI. Then it is also stipulating that it should have a net owned funds of not less than originally it was 2 crores. Gradually it is increasing, and presently it is 200 crore in case the existing ARCs. And they are also supposed to take it to 300 crores by, I believe, March 26. And in case we have to go for a new registration of ARC, then it requires upfront net owned funds of 300 crores. Then the then see these are the basic requirements of registration. And after the registration, there are certain other conditions, like every asset reconstruction company shall make an application for registration to RBI, because there are some formats, there are some forms which are prescribed, and the Reserve Bank of India, for the purpose of considering the application for registration of the asset company, even they can seek more information, they can inspect the records of the company, they can inspect the books of accounts of the company, and that they have to actually fulfill the conditions that the asset reconstruction company has not incurred losses in any of the past 3 financial years. So this is where the registration of ARCs are in fact defined. Then coming to the net owned funds, which is presently stipulated as 300 crores for setting up an ARCs. Now, the net owned funds, in fact, 300, which is earlier it was, in fact, up to March 31st, March 2024, it was 200 crore. And now all the ARCs are supposed to increase their net owned funds to 300 crore, and the time given by RBI is 31st March 2026. In case the ARCs fails to comply with these threshold, it may lead to supervisory action, including restrictions on new business, and in case it continues, then it may be even cancellation of registration. Now, the registration process, like as I say, the RBI will issue a registration of certificate, then a commencement of business certificate, then the eligibility requirement, financial soundness, should not have incurred losses in any of the 3 preceding financial years. Then the management, the directors and the key management personnel must meet and fit and proper criteria, possessing adequate experience in financial matters, operational capability, demonstrate ability to acquire, manage, and resolve stressed assets, permitted activities. ARCs are authorized to undertake securitization and asset reconstruction activities as defined under the Securitization and Reconstruction of Financial Assets and Enforcement of Security Interest Act. Restoration. So this is all the resolution applicant role. Now, when this insolvency law came, it was also decided by RBI that the ARCs can also become resolution applicant. However, the RBI stipulated that in IBC cases, in case the asset reconstruction companies has to submit a resolution plan, then the ARC must have a minimum of net owned funds of 1,000 crore, then only they can become the resolution applicant. So the prudential norms and capital adequacy ratio, which is presently applicable, that is like the ARCs must maintain a minimum capital adequacy ratio, CAR, of 15% of their risk-weighted capital. Investment restrictions are also there, and the ARCs are in fact prohibited from investing in land or building except for their own use, limited to 10% of their own funds. So provisioning norms are applicable as per the prudential norms, basically, which is the asset classification norms of RBI, which classify the assets into standard, substandard, doubtful, and lost. Other than standard assets, all are called collectively as NPA, and the provisioning requirement depends upon whether the classification of the asset is substandard or doubtful or lost assets or loss assets. So that is the basic conditions for the ARC. One, that we have said that the RBI is presently specifying from time to time. One is the capital adequacy ratio, CAR. Then secondly, the RBI is also saying the income recognition and asset classification prudential norms of RBI, which is applicable to ARCs like NBFCs and like other banks, that is applicable, which is called in common prudential norms, or in detail it is called income recognition and asset classification guidelines of RBI. Then how the funds of the ARC can be deployed, that is also something which the RBI monitor and stipulate. The management oversight is also being looked at by the RBI. Any kind of change in the management of ARC would need prior approval of RBI. Any kind of change in the sponsor will also need the RBI approval, and there are applications which are provided in the rules for the purpose of registration of an ARC with RBI. RBI can approve or reject applications due after the due process. Now, the RBI can also cancel the registration of certificate. RBI may cancel the registration of ARCs if the ARC violates terms and conditions of the registration. If the ARC stops doing the business of ARC, that is not engaged in the securitization or asset reconstruction. So what exactly Section 4 of the RBI says, I will just explain. RBI may cancel a certificate of registration granted to ARC if such company ceases to carry on the business of securitization or asset reconstruction, or ceases to receive or hold any investment from a qualified buyer. Ceases to receive or hold any investment from qualified buyer, has failed to comply with any condition subject to which the certificate of registration was granted, at any time fails to fulfill any of the conditions referred to in various clauses of RBI directions, and also like maintaining accounts, maintaining books of accounts, maintaining the standard approvals, all this. So this is something where the registration can also be cancelled by RBI based on various non-compliances, like has obtained registration by fraud or misrepresentation, have failed to maintain books of accounts and also submit various returns which are required to be submitted to RBI, disobeys RBI's direction under Section 12 or 12A. I mean, that's what is required. The one thing is regarding policy and the other is regarding data reporting. If the ARC continues operation in a manner prejudicial to the interest of public, so therefore, if the RBI, the directions are not followed, if the specific RBI directions are not followed, if the books of accounts as stipulated are not maintained, if the various returns which are required to be submitted to RBI are not being submitted, or in case the registration have been taken by some kind of wrong facts or fraud. So in all these circumstances, the registration of ARC can be cancelled. Registration of ARC can be cancelled. Now, next is the acquisition of financial assets. So at this moment, Ankit, I think we actually can take some of the questions, because I can see there are about 7 questions that we can see. And of course, it is taking time. So, but then making it interactive is very important. So we can take some questions, Ankit.
The question from Sandeep Dashji says, how does ARC make its money? Is there a spread between the bad assets which it takes over, and the value of the securities it sells?
Yes, I think the ARCs are making money. First of all, they actually, when they acquire an asset, and they acquire at a price. Now, suppose as per the bank records, it shows that the total 100 is recoverable from the obliger. Total 100 is recoverable from the obliger as per the originator's record. Originator is all those parties who have actually given, they have the financial asset in their books. The originator says that I have to recover 100 from an obliger. The obliger includes the grantor, the borrower, and other persons. Now the ARCs will make this understanding. They will see the documents. They will see the functioning of the company or functioning of the borrower. They will see the value of the collateral security. They will see the collateral securities. They will see the management. They will see all possible recoveries, and then they can say finally that we can only offer 50 as against 100, which is recoverable value. We can only offer 50 to you. So one, that out of the 50, in case they recover 60, so the balance 10 is their profit. And then, then for the 50, they are supposed to give it to the, as far as the 50 is concerned, they have to give it to the originator, to the original owner of the financial asset. That 50 that they have to give, and anything recovered over and above is the profit of the ARC. That is the number one revenue. And number two revenue, that in case they also work on fee-based, in some cases they work on fee-based. So, and also when they actually get investors for securitizations of NPA, so they may have some arrangement when the investor comes, so they can actually say that out of this profit, if the money is now contributed by an investor, then out of the profit, some part will be kept by the ARC and some part will be given to the investor. So that is the profit model as far as my understanding is concerned. And if there is any person who is an expert on ARC and is available online as of today, we can even ask that person. Of course, this is coming in detail in our subsequent slides or in subsequent two episodes. But to make this particular session also interactive, we can invite any person who has special knowledge of the revenue model of ARC.
Right. So then, of course, there's a question from Lalitji. Can ARC be a limited company by shares? Yes, sure.
Yes.
It is.
It has to be a company. It
Yeah.
has to be it is mandatory that it should be a company incorporated under the Companies Act.
So I then have a question with respect to an observation in the Phoenix ARC versus paid financial services regarding the collusion nature of certain financial creditors under IBC. I think we can answer them at the next stage. So there's a question from Mr. So the question is, who is the valuer as per the new changes? So I think we can answer that in the course of time as well. Yep, that's what I had.
Moving forward, we actually can see Section 5 of the SARFAESI law, which talks about the acquisition of financial assets by ARCs. Now, what is the law which empowers the originator to bundle all the NPAs together or some of the NPAs together and securitize it? That is Section 5. Section 5 empowers the ARCs to acquire financial assets from banks and financial institutions by issuing bonds, debentures, and other securities. Not that it has to be purchased entirely on cash. Of course, we will actually tell you the trend in the market in our subsequent episodes. But today we are saying the law says that the ARCs actually can acquire assets by issuing bonds, debentures, and other securities. They are supposed to enter into an agreement of assignment, and other RBI approvals may be required. Now, when we see the Section 5, it says, and it starts with non-obstante clause, notwithstanding anything contained in any agreement or any other law for the time being in force, any ARC may acquire financial assets of any bank or financial institutions by issuing a debenture or bond or any other security in the nature of debenture for consideration agreed upon between such company and the bank or financial institution, incorporating therein the terms and conditions as may be agreed between them, or by entering into an agreement with such bank or financial institutions for the transfer of such financial assets to such company on such terms and conditions as may be agreed between them. So now let us understand what is the mandate. Mandate is that the asset can be acquired. Number two, it is like it has a non-obstante clause. That means whatever is written in the agreements, whatever is written in any other law, the ARC can acquire an asset of a bank or financial institution, because maybe that agreement with the borrower is with the bank only. But with this clause, now the borrower cannot cannot object to such acquisition by ARC. Then the consideration can be paid by issue of debentures, bonds, or any other security in the nature of debentures for consideration. And that consideration, as I said, that the consideration out of the 100 recoverable, the ARC may offer 50. That depends upon the consideration. That is the consideration, and that depends upon the due diligence, that depends upon the valuation, that depends on the understanding of both the parties regarding recoverability of that financial asset. Then they have to enter into an agreement of assignment, and then financial asset actually will be enforceable by ARC. Any document executed by any bank or financial institution under subsection 1 in favor of the ARC for the purpose of asset reconstruction or securitization shall be exempted from stamp duty. And then the bank or financial institution is a lender in relation to financial asset, then the lender will be ARC. The lender will become ARC, will become lender. So that is where is a huge, so the entire power comes from section 5. Entire power comes from section 5, which is acquisition of financial assets by ARCs. So this particular acquisition, in fact, we can discuss in detail, like what are the effects of the acquisition and how the various judgments on acquisition, how this assignment agreement works, and what kind of judicial has actually been, because see, when we talk about the acquisition, we also have to talk about various contracts, the right to sue, enforcement powers, all this that we have to see, so that the smooth continuation of legal actions can also be there, and how the final discharge will be applicable. So, Ankit, today we are only restricting ourselves to this, like, because this acquisition of financial asset is a larger subject, and we can cover in detail the acquisition of financial assets in our part 2 of this series. Like, in the meantime, we can take one or two questions, which are in case there are some new questions are there.
Question is, can ARC acquire assets which are non-NPA accounts?
No, see, like presently, the ARC cannot acquire non-NPAs, because see, presently ARC cannot acquire standard assets. So the ARC can only acquire NPAs. But then this new RBI-led framework, for which the draft regulations have come, in that scenario, even the RBI is actually saying that the new companies which are being created, under the RBI-led resolution structure. So in that case, it is possible. The presently only ARCs can acquire NPAs.
Right. So I think the next question is that can ARC upgrade the NPA accounts in its and regularize post NPA or regulate post NPA? So in case there's an NPA account and the ARC is trying to convert it into a standard account, what happens in those cases? I believe that is the question.
So in case the original agreement with the originator is to pay the consideration, and then the ARC will be exactly free to deal with that asset, including upgradation, including further funding, and including any kind of management control of the financial asset and the entity which has taken the financial asset. But in case the agreement with the originator and the ARC is that they will recover in a period and after the recovery, the security receipts will be encashed. So in that case, the banks may not agree for any kind of upgrading and then continuing. Because the banks, when they actually assign it to ARC, their primary focus is to recover. And in case they have already recovered, then the ARC is free to upgrade.
Right. I think those are the questions that I could see.
So we can say that we will continue this subject, and we will actually talk about in the next in detail what is the acquisition of financial assets by ARC, and about the procedure, about the due diligence, about the directions of the RBI, and that is the way we are now going ahead. Subject wise, we'll take the subject, we'll take the RBI guidelines, we'll take the market trends, and then we'll move on to subject by subject. So in the next episode, we will come out with an entire process guidelines on acquisition of financial assets by ARCs. Thank you very much. Thanks a lot.
All right. Thank
It is
you.
our way of learning.